Hello Oracles, Oracle Tim here. Well, today in the markets, it didn't go quite as we were hoping it would. We weren't sure after the inflation numbers coming in yesterday, and then Fed Bullard making his comments about perhaps an emergency meeting coming up to discuss interest rates. All these fears, and then Ukraine kicking in today with Russia potentially invading Ukraine, getting a little closer to it actually happening. Markets did not like it, and the markets sold off significantly today. So we saw NASDAQ down almost 3%, Tesla was down over 5%. So we didn't see that gap get filled for Tesla today. It was so close, it got down to 850. So we have a $4 gap between 846 and 850 that still technically needs to get filled. It may happen Monday. Who knows what's going to happen over the weekend? If Ukraine does get invaded over the weekend by Russia, I could definitely see that gap getting filled and us probably dropping into the 700s on Monday. This all has, yet to be seen. We don't know what's going to happen. But if that does come to fruition, I have a feeling we will see significant selling off on Monday as well. Now, my personal feeling as far as interest rates go and inflation, I think we're going to end up hitting a point sometime in April or May where we see the numbers start to come down again, mostly because of the fact that last year, April and May, is where we started to see the number get really high. So I think that we're going to see the year-over-year data come down. Month-over-month is what we're going to have to pay attention to, though, because year-over-year may come down, but if month-over-month is still high, that could pose an issue. Now, the interest rates going up, I think, the sooner the better. There's obviously a lot of factors to get involved with this. I am not a macroeconomist. I do not know how all these little things are going to affect the grand picture and the grand scheme of things. But I do know that one of the ways to combat inflation is by raising interest rates. So looking at where the goal is of the Fed's goal is to keep our inflation between 2 and 3% because that helps for a growing, healthy economy. So we need to get inflation down to 2 or 3%, and by doing so, we keep interest rates around the same rate. And that's what keeps the balance. And it's in constant flux, but that's where they like to keep it in balance, to keep it moving in that direction. We will see how that plays out, but I think the sooner we get interest rates to where they need to be at the 2 to 3%, the sooner we see inflation come down to where it needs to be as well, and the sooner we can get back to what would be a pre-pandemic bull type movement that we had before, where we're on this nice gradual upward trend. Obviously it's been rocky lately. The last 2 years have been quite questionable, and with interest rates being zero, we saw a lot of growth stocks taking off into places that they really shouldn't have been, with extremely stretched valuations. And so now we're just seeing that natural valuation compression coming into place for us to be able to get the economy back into order now that we're coming through the pandemic. A lot of different moving pieces still need to get put into place when it comes to employment, inflation coming down, interest rates going up, the Russia-Ukraine situation needs to get resolved. So a lot of little different things that still need to go on. So I think it's still going to be quite a rocky year. I still think we are going to see a net gain at the end of the year. But I think the sooner we can get everything going, the sooner we can get interest rates going up, the sooner we're going to be able to get ourselves to a point where we can get back to normalcy and see the gradual climbing again. And now, when will we see the bottom of this? Honestly, don't know. The Russia-Ukraine situation could cause a little bit of uncertainty more than we already have been in. So I don't know where that's going to cause the market to go between now and March. March, we know that we have at least one interest rate hike going in, maybe two. We will see what happens at that point. So I don't know if that's what's going to cause the market to come down. With how much we've had selling off into this correction, we thought that maybe all of these rate hikes were already priced in, but who knows? The market does what the market wants to do. So perhaps the correction isn't done correcting and we still have some more downwards to go. We still have, when we saw that jump, I think it was last Monday, we saw a jump, and that's where we saw the gap in Tesla come in down to 846. So there's a lot of gap in the entire tech sector. A lot of the market had a gap to get filled. So we got to come back down to fill that. Whether we do or not, who knows, but there's a lot of gaps to get filled, so I'm guessing we do come down, whether it's now because of Russia-Ukraine or whether it's going to be in March when we come down. I do think we have some more coming down to go before we come back up again. And so the way I am playing this is the way I have been, dollar cost averaging into the high conviction plays that I've got, taking out the stocks that I really don't have high conviction in. If there's profits to be made, I will take them and then put that over into the higher conviction stocks. I like to keep a minimum of 5% cash on hand. I'm currently at 4%. So I'm really just building up cash reserves, and on a little bit of dips, I am buying a little bit of Tesla, a little bit of Nvidia, a little bit of Google, just dabbling in those as we're dipping down, and I'm adding to them every day. Otherwise, the majority of my money is going to cash and cash reserve plays like QYLD. So this way I can have those things freed up in case I want to dip more into some of my higher conviction stocks. Now I've got stocks like Affirm that I thought were going to do well at earnings, that I could have sold for some profits. I got really close to break even on it, and then earnings got leaked early. Obviously they did not do well. For those of you who have Affirm, I'm sorry, it was not a pleasant day yesterday or today. What's going to happen with Affirm going forward, I don't know. My personal play with that is I'm going to hold on to it. Kind of getting mixed reviews from analysts. Some have downgraded Affirm, and others have kept overweight ratings with $140 price targets. So it's a very wide range of analyst perception of the stock. So for me, I'm just going to hold it. I don't want to take a loss, because you don't take a loss until you actually sell. So I'm going to hold on to Affirm. Maybe it does well in further earnings over the course of the year, and I can get profitable and free that money up to be able to put into my higher conviction stocks. If we get to the end of the year and Affirm has not rebounded, I may just take that for a loss and balance off any profits that I have taken on over the year. And this is basically how I'm going to play up my entire portfolio, is consolidation. Consolidating my stock portfolio down to the maybe 10 to 12 stocks that I want to have in my core positions, and then free up the rest. And I'm not just going to sell off the rest. I'm in the red for a lot of them, because a lot of them I was holding long term and they bombed hard because they were higher growth stocks, and I thought I had another month before we were going to see the correction. I mistimed it. Whatever, it happens. I'm not too concerned. I don't have a ton of money tied up in that. Those stocks are about 5 to 10% of my portfolio. So if they come back and they go green, I'll sell them to free up cash. If not, they'll just sit there until later, maybe till the end of the year, to sell off for losses as well. And so some of the top stocks that I'm holding on to and adding to as we come down on this dip are, like I said, Tesla, Nvidia, Google. I'm also adding to SoFi, Square, and Enphase as some of my other plays. And these I'm looking at long term. Square is kind of an uncertain play for me right now. It came down really hard. I was in just over 200. Dollar cost averaged my way down to 184. So I may dollar cost average a little bit further down, but that one is kind of on the cusp of not sure if I want to hold it or sell it. I'm just going to see how it plays out. They do have earnings coming up, so I'll see how that goes. Otherwise, even with the adding that I'm doing, it's very small amounts. I can do fractional trading here in the US. So for me, I do $15 in Tesla every day, and then $15 for every percent it drops. Now below 900, because it had been in the middle bouncing up and down, and I noticed that most of my buys were coming in at the same price, and that wasn't doing anything for me to help lower my dollar cost average. I'm also adding every day to Nvidia, to Google, and then just a couple of dollars here and there. It's not a lot, but I don't have a large portfolio, so it's just my way of dollar cost averaging. And again, we don't know when the bottom is going to be, so if I can do this on an everyday basis or on an every percent basis, it makes it easier for me to manage as it's coming down and still keep that cash on the side and not have to worry about trying to time a bottom. Let me know in the comments below. What are your thoughts on the turbulence going on between Russia and Ukraine? Do you think that this is going to last a while? How hard do you think it's going to hit the market? And do you think it's going to hit the market for a long time? Thank you all so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.